Hey, and welcome to the DadAdvice channel. If it's your first time, we're a community created to learn and grow together. If you find this content beneficial, we'd love for you to like and subscribe to the video and share it with somebody that it might positively impact. With that being said, let's get into it. Lend money to an enemy, and thou will gain him. To a friend, and thou will lose him. Benjamin Franklin. I chose this quote in regards to what we're going to discuss today, because what he is saying is we're going to be much more cautious when we're lending or investing with somebody we don't know. But when we're investing or lending to a friend or a family member, we are going to be more likely to throw caution to the wind, unfortunately. So we're more likely to make a poor decision. Today, we're going to discuss what to look for when investing in private equity investments. Before we even get into that, I'm probably going to do a separate video on private equity investments. But just so you know, what is private equity? In essence, it's the investment of equity capital into a private company. So it can be you're investing in your next door neighbor. He's a plumber, investing in a company that's not traded on your common stock exchange. So it's not publicly traded. This story is one that has been a learning lesson for me, and a big learning lesson, and happened luckily early on in my investing career. And was starting to look into private syndications, and I was referred. And the reason I'm going to share this story with you is because you can, once we go through the 10 things to look for when investing in private equity, it's going to tie back in. You're going to see how I did not use these things, and I could have seen the flashing red lights before. So there was this huge guy that I was introduced to by a friend. I didn't know who he was. He was in this paid mastermind. I wasn't in the paid mastermind, but my friend or acquaintance who knew him was in that paid mastermind. And he was, and my friend that I knew was successful in flipping houses in Baltimore. And so I took that as like, hey, he's like, this dude is giving out crazy returns. They're like 20 to 30% within a couple months. And the other gentleman was doing large multifamily syndications. He was doing, or pretending to do, large multifamily syndications that he was portraying to do and give those returns. And he would have these pro formas from commercial properties, and they look sexy and great. It's like, oh man, this is pretty cool. Why would I ever invest my money with myself or anybody else if I can get 20 to 30% returns in 2 months? So that was the backdrop. And fast forward, I invested $50K with him, and everything started kind of falling apart after the investment, whether it was communication. But what he was doing is trying to suck people's money more and more. So you would give him your investment, he would pay out the first return, and then after that, he would try to get another investment, but just never pay out again. So he tried to kind of double bang you. Luckily, I saw the writing on the wall after I invested and go, wow, there's something going on here. And the FBI ended up getting involved in this. They called me and said, hey, are you working with this person? And I was a former police officer, so I was very documented and regimented at all my stuff. Said, here you go, I'll share my share drive with all our text conversations and everything. And I didn't get mad, but here's all the stuff that I kept. So FBI got involved, and luckily I got my capital back. But how does that? I didn't get I got most of my capital back, luckily. But let's go into what to look for, or the 10 big things to look for when investing in private equity. The number one is evaluate track record, experience, and qualification. My preference is the team has been successful in executing in the same asset class. What you don't want is your money to be the learning lesson for this operator. So if they're always running a plumbing company and they run it great, and they open up an IT computer company, well, that doesn't count. But if they're opening up another plumbing company, then great. they've been successful with this one, they'll probably be successful. Humans are habitual creatures. And I'll share just a little tidbit why this is super important. There was a very well-renowned Montessori teacher that I was thinking about investing with, but she was just a teacher and educator. She had never actually owned a business. She started and opening up a business, and she ended up asking for investors to give them equity of the business. I ended up deciding to pass, even though they already had the building, they already were starting to run, but they didn't really have numbers or a track record here. Fast forward to that one, they closed because of zoning and a bunch of permit stuff that they were not foreseeing. So luckily, I avoided that one. But this is the importance of having that track record and being successful in the same asset class. You don't know what you don't know, and starting up a business is super difficult for those of you that have started up a business. Number 2, understand the investment. So understand how they make money, what the risks are, and how the market conditions can affect them. Does COVID affect them in some way? I mean, and that's a once in a lifetime, hopefully once in a lifetime thing. But so understand just how they make money, how they're going to disperse it back to you. Understand the investment. If you don't understand air balloon business, then or the hot air balloon business, then don't invest in the hot air balloon business without doing your due diligence. Number 3, verify legal structure. So ask for the corporation documents, the LLCs, any operating agreements. Take a peek at them. If they don't have these developed, then why would you ever want to invest in somebody that isn't structurally and legally protected? Number 4, verify financials. So a lot of people use QuickBooks. Some people do spreadsheets. They should have some sort of financials that you can look at. Maybe it's from a different business and they're going on to this one. Can I see your financials from your other business? Just see how their financials are. Ask about their accountant, their bookkeeper. If a business operator does not have an accountant or a bookkeeper, this is a red flag and it should stick out. Not to say that they can't be successful, but it's just much harder if you don't have these puzzle pieces in place. Number 5, ask for a sample statement. And this is just a sample investor statement or how they are going to update their investors or their equity holders. And what's the frequency that they send it out? Do they send it out monthly? Do they send it out quarterly? Do they send it out yearly? But it's nice just to see what a statement looks like. What information does it have on there? Number 6, what assets are at stake? Are they personally liable for this stuff? Is it just the LLC that's liable? Do they have a bank account or assets that are in a bank account? Can you see those statements? What kind of leverage is involved? So just what assets are at stake? You should understand that. Understanding the operator's exit strategy. So if you're investing in some sort of plumbing company, understand the timeline and the associated opportunity costs. So if they're going to, hey, I'm going to hold on to this plumbing company and sell it in 25 years and I'm not dispersing anything, well, you're going to want to know that because you're not going to be getting money back until 25 years later. Number 8 is put your toe in with the first investment. My preference is do the minimum investment with people and operators when you're investing with them for the first time. This allows you to feel out how they run their business. How do their statements look? Are they on time? Are they sending out their their K1s or 1099s on time? Do they communicate well? Are they not meeting their assumptions? So they're telling you they're going to do X, but they're only making X. So it allows you to get a good feel and, hey, I trust this person. I understand their character. Boom. And also shows you how organized they are. Number 9 is understand operator burnout risk. I don't think a lot of people talk about this, but just being an operator myself, I find that the biggest risk to most businesses is when an operator gets way too stressed and just says, I'm not going to do it anymore. We can only operate at a super high stress level for so long. And most people can't and won't operate in a high stress level forever, especially if it's not their passion. Number 10, which is a big one, is trust your gut. If the investment doesn't feel right, there's plenty of other investments out there. You don't need to invest in this one. Don't have FOMO, fear of missing out, because, hey, I really want to invest in this one. So with that all being said, I did want to hit a few red flags. I did a short on this video, but this is just important too. So you can just go through those 10 and we'll have them listed out in the description. You can go through those 10, and normally if you go through those 10, it's going to give you a pretty good idea if you want to or don't want to invest in that investment. Red flags that should stand out are the proven track record. Startups have a high percentage of failure, so just be careful. I personally would not invest in a startup. You can get returns elsewhere. If they're promising oversized returns, that's a big red flag. 20% plus per year, it should be a red flag. If they can get 20% plus per year, I mean, why would they be passing that on to investors? It just doesn't make a lot of sense. Getting caught up in the story, not the numbers. So you're getting caught up in whatever the razzle dazzle they got, and you're not getting caught up in the facts and the statements that they're providing. Friends of friends referrals. Do your own due diligence. So don't just be like me and be like, oh, I trust that guy, so he's referring this guy. You still need to do your own due diligence on the guy. If the operators use term like guarantee or sure thing with returns, that is a red flag, because most sophisticated operators are not going to use the words guarantee. They just stay away from it. And then once you are invested with somebody, just know if communication is a problem, that is a red flag. Most people, when you're trying to invest with them, are great communicators. And then after you've invested with them, you'll notice, they don't communicate as well as they did when they were asking for my money now that they have my money. So hopefully this helps. I wish you guys an awesome financial journey to your success. So love you. Hope this helps. Like and subscribe to the video, and I'll keep bringing the content. See you guys.